CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent like January and February, that's a reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking, and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can like buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's like very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products, because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things, because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year. enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters off Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you aren't from this side. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the GOAN executive conduct matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who had spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud. A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as sort of desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was... Okay, traders, well done. We sold British pound, as you can see, just after 5 o'clock. Great, good trade. We made £5,000. All of you guys who follow my trade, well done. So stay with me, and as soon as I will see something that will be available on your screen, I will let you know. Don't forget, if you want to get the strategy, you need to go to companyeye.co.uk and you can get the strategy from our website. Okay? I'll speak to you later. Stay safe. And it was a good trade. Okay? Stay safe.
Looking at these corporate claims of dramatically reduced emissions. And we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues. And they've been around for 7 decades. They've preserved about 125 million acres of land. And they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving. And most importantly, they've probably gotten off of one before. They've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be part of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen. That actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed, wildly ashed the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Markets are selling off on the bet for a much more aggressive Fed. It's now 2 p.m. on Wall Street. Equities trading off session lows. From Bloomberg World Headquarters in New York, I'm Doug Krisner. At its worst point of the morning, the S&P 500 was down nearly 3.9%. But at the moment, the S&P is weaker by just, and I say just, 2.7% right now. We have the decline being paced by consumer discretionary, also seeing weakness among real estate, energy, and utility stocks. Dow Industrial Average weaker by about 2% right now, and the NASDAQ Composite declining by 3.4%. Markets are now pricing in 175 basis points of Fed tightening by September. That would imply 2 half-point rate hikes, perhaps the first as soon as this Wednesday, and then potentially a 75 basis point increase. If it were to play out in that way, this would be the first time since 1994 that the Fed has resorted to such extreme measures. Frances Donald is the chief economist at Manulife Asset Management. She says any sign of economic weakness will not alter the Fed's path toward higher rates.
Despite all of these leading indicators, we have not seen the central banks blink. In fact, last week we saw most central banks that were speaking actually appear even more hawkish. So the hope that bad news would be good news and to create a reversal in this market, it's just falling away in front of us.
So if you look at the bond market today, yields across the U.S. Treasury curve have spiked. We have a 10-year now at 3.34%. The gain is nearly 19 basis points. On the shorter end of the curve, we have a 2-year at 3.25% with a gain of more than 19 basis points. So this move up in yields, strengthening the dollar, the greenback enjoying its best 4-day rally since the beginning of the pandemic. However, that dollar strength is going to erode the value of offshore revenue for U.S. multinational firms. The Bloomberg Dollar Spot Index right now higher by 0.8%. That is your Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
And a very good afternoon, everyone. Live from the Bloomberg Interactive Brokers studio. We are streaming on YouTube. We are also from Tim's home in Brooklyn. How are you?
I'm doing well. How are you?
I'm doing okay. I just said to somebody, though, it's been a full Monday, and I feel like we should be later in the week already.
Yeah. Hey, thanks for holding on the fort today. Really appreciate it.
Well, happy. I'm so glad you're still with us. It is Monday, June 13th, 2022. The superlatives continue in a year that's already chock full of them. S&P 500 teetering on a bear market. I don't think we're there yet. Are we? Oh, we are. Creedy says.
We are. Are we going to close there? That's the question.
Right. Exactly. So it's not pretty. Also, Treasury yields spiking to levels not seen in a decade. The dollar powering on. All of this as the Fed has to consider what it does next. We know they're going to raise interest rates, but then do they get more aggressive in the tone, Tim, going forward?
Yeah, other central bank action happening too this week. We're going to have more on that in just a minute. Also, Carol, we're going to kick off with a Bloomberg exclusive.
Arnold Donald, CEO of Carnival Corporation, on volatility, consumers transitioning to vice chairman after a long and often difficult run as CEO. He had to deal with a lot of crises, including the pandemic. So he's going to join us exclusively. And then amid the stock market sell-off, we are all becoming one kind of investor. We're going to explain that.
Yeah, plus the oil price shock will reverberate into next year. Not very good news for this summer or people looking for those prices to fall. And then back with us, Julia Collins, the founder and CEO of Planet Forward, on making climate-friendly snacks from regenerative ingredients.
All right, looking forward to all of this. Let's get to the Market Drivers Report. Let's set the Business Week agenda in the house. Kriti Gupta, who just nodded at me, markets correspondent at Bloomberg in our Interactive Broker studio. So too is Christina Aquino. She is Europe FX and rates team leader. So much going on in terms of global central banks this week, so we had to have her in. She is, of course, with our Bloomberg News team. Kriti, let's kick it off with you. Negative risk-off trade, but not as negative as it was a little bit earlier, but also not as positive as it was a little bit earlier.
Yeah, well, 3% declines, nothing to scoff at here. I think the biggest move to me is in the Russell 2000. We've seen 4% declines. A lot of this, of course, coming from your tech, your natural tech, the stocks that lead you to those record highs. They're the ones leading you to the downside. But if we have to look for a major driver here, there's a couple of things. You have the inflation story story, which of course is always going to spook markets right off the bat, but it's also the yields, and it's what Tom Keene would call the second derivative idea, the how fast are the moves happening. It's not just about yields moving higher and keeping up with inflation in the Fed. It's yields moving higher in 17 basis points all at once in one day, or 19, I guess now, on the 10-year yield, 334.
And that yield curve, right?
And that yield curve, flattening and flattening. And for the folks who aren't familiar with the bond market, when you have that flattening of the yield curve, it means that that extra risk that you're taking further out in the curve, it's not paying off. It means that premium, it's not worth the risk. And that's really where you see that spread essentially close a little bit. I'm making like weird claw kind of images with my hands, but it's important to kind of talk about here, because when you see that kind of action, to see a stronger dollar on the back of it, none of this is supportive of what a healthy market should look like. And one of the narratives I'm hearing is simply, this is a re-rating of markets, it coming down to a revaluations of markets. So even if you do hit 3,600 or even 3,400, which is the pre-COVID high, I mean, folks, we're at just shy of 3,800 right now. That is an enormous drop that people are saying the selling, well, it's not over even if you did hit that 20% bear market territory.
Although, I'm going to tell you, Tim, a very wise person in our newsroom said to me, I'm buying because, man, these things are like on sale big time.
You totally should buy if you're like have a very long
Whoa. We're not giving investment
We're
advice
not giving,
here.
I'm just telling you anecdotally what a wise person in the newsroom said to me that they are doing with their own money.
Okay, noted. Hey, Christine, come on in here. I'm wondering what changed between, the close of market on Friday and what we're seeing out there today, because the data was ugly, but we got that at 8:30 Friday morning. Is it just the idea that there were a lot of notes over the weekend and there's serious concern about the Fed having to act more aggressively, more so than we had on Friday?
Well, Jim, I think those notes, you're right. You're absolutely right. I think it really what kicked off the Friday afternoon slog that we had to deal with just before the weekend. But, those notes are really emblematic of, again, this broader realization in markets that, oh, wow, the Fed is going to have to do much, much more than it originally indicated because inflation keeps surprising to the upside. And that really is kind of the big takeaway from last Friday's numbers is that, again, that whole narrative of peak inflation, which I think a lot of people wanted to really latch onto, that's out the window now because we're back to 40-year highs for the CPI figure, and it's really driving home the point that if the Fed doesn't go big on inflation, then they might as well go home.
All right, but what does it mean for global central banks, what they're all tackling with? Not everybody has the same strategy right now.
Absolutely, Carolyn. But I think, think of the Fed as Jupiter and then the rest of the central banks as the smaller planets in its orbit. It really has this just tendency to kind of just drag everything. It has enough gravity to drag everything towards its direction. And so this is exactly what we're seeing, for instance, with the Bank of England, which is also meeting this week, a day after the Fed. So I do not envy those central bankers having to contend with the Fed decision and then factor that into their own, but also other central banks that are closer to the more dovish end of the spectrum. I'm talking about the European Central Bank, the Bank of Japan. Both of these banks haven't even taken the first step toward raising rates. Yet markets are already pricing in rate hikes from those central banks because, again, the idea is that if the Fed goes one way and if it goes big one way, then the rest of them are bound to follow eventually.
Creedy, just quickly, market capitulation. I've been looking at 52-week lows on the S&P 500. One read was about 149 names that we've seen. Doesn't quite feel like we're there yet.
It doesn't feel like we're there, and this is something that a lot of people on Wall Street are saying that's going to be when this selling ends, when everyone kind of throws their hands up in the air and says, you know what, I'm going to get completely out of the market. But let me offer a contrarian take. The opposite view of that is that do you need capitulation for a market return? And some people say we do, just because that has been the historical trend, but that isn't necessarily true every time. And after all, we are in unprecedented times.
And right now we've got the VIX. What do we have at 32.77? So it's up about 5 points here in today's session. Although I was at a guest earlier on Bloomberg was saying, okay, for the VIX, 40 is the new 30. It's not about 30, it's about 40.
I used to say 30 is the new 20. I wonder if they took that from me.
I don't know.
It's a game that never ends.
Exactly. All right, guys, we got to run. Christina Aquino, Europe FX and Rates team leader at Bloomberg News here in our Interactive Broker studio, along with Creedy Gupta, markets correspondent at Bloomberg, also in studio.
Let's get the check of the latest world and national news. For that, we head from New York City to Washington, D.C. with the check of Nancy Lyons. Hey, Nance.
Thanks, Tim. The focus during today's House hearing on January 6th focused on what committee members called the big lie, former President Trump's false claims of voter fraud. Trump's campaign manager, Bill Stepien, was supposed to testify in person but had to bow out due to his wife going into labor. Excerpts, though, of his deposition were used today, including how he told Trump on election night it was too early to determine the outcome of the election, despite other aides telling Trump to claim victory.
It was far too early to be making any calls like that. Ballots were still being counted. Ballots were still going to be counted for days. And it was far too early to be making any proclamation like that.
Again, Trump's campaign manager, Bill Stepien. A bipartisan group of senators is pressing ahead with legislation to reduce gun violence that includes stronger background checks for those under the age of 21 and incentives for states to enact red flag laws. Democratic Senator Chris Coons.
It's not everything the Democratic caucus would have wanted, but it's a significant step forward.
Senator Chris Coons. President Biden has praised the proposal, saying if it passes, it would be the most significant gun safety legislation in Congress in decades. Also in the Senate, legislation regarding toxic burn pits may be passed this week. The measure would expand health care for veterans who've been exposed to toxic burn pits. The Senate is scheduled to hold 2 amendment votes this week, with the legislation possibly being passed as early as Wednesday. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar along with Tim Stanovic here on Bloomberg Radio. And in just a moment, joining us on both radio and TV and on YouTube will be Carnival CEO Arnold Donald, who will be transitioning to the vice chairman position come August 1st. But looking forward to his conversation about where we are in the cruise industry amid all this volatility, what is going on. So we'll get to him in just a moment. Speaking of just things that are going on Wall Street, there's a great story, Tim, by our Greg Farrell and Chris Dolmetsch about texts.
Yeah, the Wall Street's top cop saying that texts can hold a firm-ending, quote, bomb. What we're talking about is, not necessarily traditional types of text messages. The top federal prosecutor overseeing Wall Street says big banks and hedge funds should get a handle on employees' use of messaging services. We're talking about apps like Signal, WhatsApp, and more, because those encrypted apps are where his people will look for evidence of criminal activity.
I mean, this is really fascinating, but it also gets to, increasingly in terms of how Wall Street communicates and where they can go to find either indications of something being done wrong. But I mean, we have seen steps certainly increasingly being taken and heightened scrutiny, if you will, coming off the financial crisis in terms of conversations that are going on Wall Street.
Yeah, we're talking about Damian Williams, U.S. Attorney for the Southern District of New York. In an interview with Bloomberg, Williams said that major white-collar cases Williams' office brought in the past 2 months highlight the kind of behavior that he's targeting. Last month, the unit Allianz pleaded guilty to shoddy oversight of its structured alpha funds and agreed to pay nearly $6 billion in fines and restitution. Then, Carol, a week later, Glencore entered 2 guilty pleas and agreed to pay $1.1 billion for failing to find and report internal misconduct involving bribes and market manipulation.
All right, well, more, just go to Bloomberg.com. So what do you want to know about the cruise industry as we get ready for Arnold Donald?
What do I want to know? Yeah. I want to know everything. I want to know exactly how they're planning for higher fuel prices to continue. I want to know the state of the economy, not just here in the United States, but globally, and if they're starting to see softness. And then are those higher airfares, are those eating into customer demand? Because people got to fly to go on these cruises.
Absolutely. I'm just curious. And listen, this guy has seen a lot. Can't wait to talk with him. This is Bloomberg. our TV audience joining us at this time, and we mostly want to welcome Arnold Donald, who is back with us on Bloomberg TV, radio, and YouTube. He is, of course, the CEO of Carnival Corporation. Arnold, you're joining us from Puerto Rico, San Juan, on this Monday. So great to have you here and back with us. How are you?
I'm great, Carol. It's always good to be with you guys.
All right, so much. I think you heard the tease of my co-host Tim Stenovic saying, what do we want to know from Arnold Donald? We want to know everything. You see so much, you have seen so much in your tenure, and we'll get to that a little bit later on because I know you're going to take over as vice chairman come August. But let's talk about the environment, the market environment, first of all. Very volatile. You know your stock, like so many in the S&P 500, are hitting 52-week lows just in today's session. I think it's down about 50%. How does the stock drop? How does the market volatility and the uncertainty about the outlook impact your business right now?
Well, of course, it's disappointing to see, low share prices that really, in our opinion, don't reflect the longer-term view of our business or of our industry. But we understand, we're part of the general market conditions, and that's where we are right now. But as you know, stocks go up, they come down. Our job in management is to ensure that we steward the shareholders' assets to create value over time, and that's what we're focused on.
Hey, Arnold, one thing though, like you have seen a lot of crises, right? You certainly came in and had to deal with a lot at the company. You've been there since July of 2013. You had to deal with the pandemic, not an easy environment. How would you assess this environment, especially when you look at the inflationary side of this, that I've been on one of your ships, I see all the food, the labor, the fuel costs. How do you assess this environment, unlike anything you've ever seen before?
Now, I wouldn't say it's unlike anything I've ever seen before. We've seen fuel prices spike in the past. While I've been CEO for 9 years, I was on the board, been on the board for over 20 years plus. And so we've seen fuel prices spike before. We've also seen inflationary periods before. I think what's critical for our business looking forward is our industry, and especially our 9 World Line Cruise Line brands. While we're not recession-proof, we do tend to be recession-resilient. And the reason is because, people who are fortunate to be employed, they still want to take time off. And we're just such a much greater value relative to equivalent land-based vacation that we often, do pretty well even in recession environments.
Are you counting on a recession later this year? I know you guys are getting all your ships back, and I think the expectation is by the end of the year, but are you thinking about with your management team and teams thinking that you're going to be facing a recession later on this year or maybe next year?
With 9 World Line Cruise Line brands and going over 700 destinations around the world, the most beautiful places in the world and all of that, but still around the world, we're always facing something. So there's always an economic crisis somewhere. A global recession, would it come? Again, we're prepared to try to weather that storm. We have sufficient liquidity. We've done over $29 billion of financial transactions since the beginning of COVID, this COVID period. And so we are well positioned with liquidity. As we said in the last, I can't give a full business update now because we're between quarters, but from the last business update we gave at that time, we had 3/4 of the fleet sailing. Occupancy on those ships that were sailing was starting to increase. Obviously, the pandemic has taken a turn for the better more recently, and you can see protocols beginning to be relaxed and restrictions lifted in many areas, which bodes well for travel in general in our business. And so, we see an opportunity to generate cash, accelerate repayment of the debt over time, ultimately, obviously, creating shareholder value. So if recession comes, if there's additional global tensions, which, there's always somewhere in the world, every year, something going on, natural disasters, all of that, we're an industry and we're a business and a company, engineered to weather through storms. And eventually we'll be getting back to the kind of cash generation that we're known for.
Do you know when?
I wish I knew when. I wish I had that crystal ball, Carol. Come on. Yeah. But I don't know exactly when, but, as we said in the last business update, we're expecting to be, pretty much at full operations in 2023, if not before. And that's what we said in the last business update. We'll be giving an update here in another week or so. And we'll see where we are. But it's, we see a lot of fundamentals that are positive, despite these other macro dynamics, which are obviously less positive and currently reflected in the market.
Are your pricing power, is that one of the positives? Because I am curious about how you are dealing with the increase in bunker fuel costs. You know, are you able to raise prices to kind of offset some of the higher costs? And again, I talked about higher food costs, higher labor. Are you able to raise ticket prices?
You know, again, we're a global business. And so we can't just hit a switch and automatically raise prices because fuel prices have gone up. If there's sustained increase in fuel prices, as opposed to spikes and troughs, if there's a sustained high level of fuel pricing, obviously that will ultimately get reflected in the cost to the traveler. But right now we have, you know, pent up demand, somewhat limited capacity because we're not operating at 100% yet. And those are good tailwinds. Obviously, we do have the headwinds of higher fuel prices and still some restrictions in a number of the world in terms of number of areas in the world in terms of protocols and constraints on being able to sell at full occupancy in terms of accessing complete pools of guests who would like to sail with us. So, you know, we're managing through all that. The overall longer term picture, though, Carol, is really, you know, positive for the industry and certainly positive for our.
One thing I like talking about you, and I said to you, Arnold, you've dealt with a lot of crises, certainly at the company in specific, and you've seen a lot of different economic cycles, certainly, as you said, as you were chairman or on the board at Carnival, and then, of course, as running the company. So how is it we're at such an interesting time right now, right? Dealing with higher inflation, this tight labor market, a Fed that is increasingly going to be, it seems, more and more aggressive. It feels really uncomfortable and complicated. How do you kind of make sense of it? And what can you say? Do you see any kind of easing in some of the supply chain pressures? Is there anything out there? You talk about consumer demand. Do you have a lot of confidence that that keeps coming, you know, for a while, or do you start to see some weakness there?
No, we, again, as I mentioned, we're not recession proof. Historically, we've been recession resilient. And right now, we certainly see pent up demand. People want to travel. You know, they want to share experiences. You know, they really are looking for experiences. So those are the tailwinds. There's constraints around that today, but those constraints are becoming fewer and less in terms of just the ability to feel that they can travel with certainty, not be concerned if they leave the country that they can get back in, not being concerned when they get to the airport whether they're going to be able to board the plane or not, or whether the plane is actually going to go or not. And so as those concerns evaporate, and for example, as we said in the last business update, our Carnival brand, which is primarily a drive-to market here in the States, where people have a sense of self-control, the Carnival brand led the way back. They had a number of itineraries that were already 100% plus occupancy, even with the constraints in place. Because itineraries were familiar, we were able to go to the places that Carnival went to pre-COVID, and access was available in a way where people felt they had self-control. When you start having to fly, go to different countries, not sure what the rules are going to be when you land, what they're going to be when you come back, you know, obviously that impedes demand. But that's disappearing as well. There's a number of countries, as you know, Australia has opened up, the UK has dropped, even the United States now has dropped testing as a requirement to re-enter. So as those uncertainties evaporate, that pent-up latent demand for people to have experience, to want to travel and experience, that's ultimately what drives our business, and it's what we're really great at, and we do it at a value that's much better than equivalent land-based vacation.
Does it even...
Better, less money.
No, forgive me. Go ahead. I'm sorry.
Oh, no, you go right ahead.
Well, and I'm going to bring in my co-host, Tim Stenevec, in just a moment, but I want to ask you, do the higher airfares, are they, like as you said, for domestic, it's where people can drive to a Carnival cruise line, certainly has made it easier. But I wonder, Arnold, in terms of people popping on a plane, we've been looking at airfares just getting more and more expensive. Is that at all any signs that that's problematic of people jumping on one of your ships?
Of course, pricing matters for air. I think what matters more right now is the certainty. So if people know that they're able to travel to go and come back home, and they know they can do that, that's a much bigger barrier. Although pricing, of course, ultimately will impact. If pricing is thousands of dollars, you know, to fly overseas, to take a cruise that actually costs a lot less than the airfare, you know, that can impede travel. So we'll have to see how that plays out.
All right, I told you Tim had a million questions, wanted to know everything from you. Let me bring in Tim Stanovic. Hey, Tim.
Hey, thanks so much, Carol. Hey, Arnold, good to chat with you again. I wanted to go back to something that you said to Carol just a few minutes ago. You've seen fuel spikes like this in the past. You've seen inflationary periods like this before. But is there anything that indicates to you that this time is different when you look out across the macroeconomic landscape? After all, we haven't seen an inflationary period like this in 40 years.
I think what's different, and each one is always different, always has its own context. The context in this case is we're coming off a global pandemic where the world shut down, where portions of the world are still relatively closed. And that's a different context to come out of. In our case, for cruise, in a way, we're coming out of it in a different way. In the past, when we had these experiences, we were already at full fleet and sailing full scale. Because of the pandemic, we have been slowly coming back. We've come back in stages and phasing the reentry of ships. Also, we've been able to exit our less efficient ships. So we exited almost 22 ships now. And we've added new ships, which are, far more efficient, not just from a fuel standpoint, but also efficient from a revenue generating standpoint with guests. And so we've replaced less efficient with more efficient. We're coming back in a phased way. We have pent up demand. Those are the positive things for us in this environment as our business relates to it. In the overall macro environment, of course, every case is an individual case, and the timing of how long things last and when they turn around and come back varies. Who knows what the unique combination here is going to create. But what we do know is that things pass. So we had a pandemic. That's all we could talk about for quite a while. And now it's become less of the conversation, although it still is having obviously some lasting impact. And so things will pass. And the trick is to be well positioned to take advantage of the environment when they do.
It is pretty remarkable, though, right, Arnold? You go from pandemic and then the war in Ukraine, and you guys have a fair amount of exposure over in Europe. Talk to us about that and what you're seeing there for that business specifically. And again, it's just a reminder, right, that things come out of nowhere or seemingly nowhere.
Well, first of all, like everyone, our heart goes out to anyone directly impacted by the invasion of Ukraine. And we have a number of Ukrainian employees. We also have a number of Russian crew, thousands of Ukrainians and hundreds to a few thousand of Russians. And so, our heart goes out to anybody directly impacted. That's number one. Number two, I think as we look at Europe overall, clearly that is having an impact on Europe. There's no question about it. Beyond that, there was already, pre-COVID, pre-invasion of Ukraine, there were dynamics in Europe that were more challenging from an economic environment standpoint. And so you put all that together, and Europe, is facing a challenging economic time, perhaps even more so, and I think most economists would say even more so, say, than the United States or some other parts of the world. And so that's the reality of the situation. Having said that, what we're doing is we've, taken a hard look at our European businesses, and you can't paint Europe with a broad brush, obviously. The UK is different than Germany, which is different than the Mediterranean, and so on and so forth. But as you go into Europe and look at the different areas, collectively, we're making decisions to make certain in the short term that we're doing what we can do to, allocate assets and pay attention to the specific dynamics to give us the best opportunity to generate the cash we need to generate to accelerate repayment of debt and create the shareholder value we want to over time.
But the timeline on that one is unpredictable, longer than what we're seeing certainly in U.S. markets and elsewhere?
Yeah, Tim, Carol, both of you guys, yeah, absolutely. Who can predict what, right? So we are used to living in a period of uncertainty. Everybody would love answers and all of that, but we can all kind of describe the problems we see. And the trick for us is to be flexible, resilient, adaptable, so that we're able to manage through the tough times So when the better times come, we're well positioned to take full advantage of them.
Arnold, one thing I do wonder, and Tim and I have been asked this with kind of all the leaders that we talk to, is what is it about that's happening geopolitically with Russia and Ukraine that makes you rethink maybe longer term strategy when it comes to Europe? Is there anything? And I know you said it's too early to make a lot of decisions, but we do see businesses pulling out, big name, well-known household names pulling out. Is there anything that's happening there that's making you rethink the exposure of your company?
Well, you absolutely have to be able to survive tough times. You have to react to the situation that you're in, and so we are reacting in Europe. We exited a number of ships in Europe so that we cut our cash burn. We're reallocating ships in some cases from certain brands to other brands and so on and so forth, because you need to manage real time in the situation. Having said that, we think overall the longer term view in Europe is going to be very positive and over time. And so in the near term, you adapt and you make the changes you have to, being prepared for the longer term view. But this isn't necessarily the time to be investing disproportionately in Europe, say, versus the U.S. or something. It's probably not the time for that. But you are going to continue to make investments and sustain your business and scale back where you can and reallocate in the near term until the picture changes for the better, more consistently and overall.
Arnold, I'm wondering specifically when it comes to Europe, because Carol and I last month were at the Milken Institute Global Conference, and one theme that came up over and over again was concern about Europe's economy. But you yourself said you can't paint the entire region with a single brush. Talk to us about regional differences that you're seeing when it comes to economies right now, and if you're seeing pockets of strength versus pockets of weakness in some areas.
Well, just through the lens we look at from cruising, obviously, we're not going to Russia right now. St. Petersburg was a destination on a lot of itineraries, especially in the summertime. There were very high yielding itineraries. It's a very popular destination, et cetera.
Do you think you'll ever go back?
Ever is a long time. So ever, I'm sure.
Well, let me ask the question a different way.
Near term.
What would need to happen in order to get St. Petersburg back on your itinerary?
Well, first of all, there needs to be peace. And, that's first and foremost. And then from there, we would have to see what, the restrictions are, the sanctions are, et cetera, if there are any and so on. But we believe in going to places where people want to go and where the locals want people to come. So we do believe in doing that. And within, of course, our ultimate responsibilities and our top priority, compliance, environmental protection, and the health, safety, and well-being of everyone. So we're going to be in compliance with local as well as international and our home state and flag state, regulations. So it'll take that it's okay to go from a compliance and regulatory standpoint, and it would take that it's safe for people to go and it serves the best interests of health for everyone involved.
All right, we're talking to the CEO of Carnival Corporation, Arnold Donald, joining us via Zoom from Puerto Rico. Hey, one more thing on the business, and then I want to step back and talk more broadly with you. Labor. And one thing I noticed when I was on one of your ships and did a deep dive into the company several years ago was the amount of workers, and workers it's a global workforce. It was kind of fascinating for me. And it was also contract workers and things. Tell me about getting access to the workers you need, and is any of that holding you back from getting ships out to sea? And the cost of it. Yeah.
We're a city at sea, as you know, Carol.
Yep.
And so we have lots of different types of workers and laborers and crew and executives, et cetera. But the reality is we recruit from over 145 countries around the world. And what happened during the pandemic is, and typically we'll recruit 20,000 plus people annually. And so we have a whole machine to do that around the world. And that machine stopped during the pandemic. And so that pipeline, because it's not just hiring somebody and putting them on a ship, they have to have a certain level of training and so on. And so that whole pipeline emptied. And right now, what we've been going through, and it kind of has worked out because we didn't bring all the ships back at once, but it's still been challenging at times, especially in certain areas like medical and certain other areas on board the ship where demand is high, for other reasons around the globe. But now that we're getting the machine back up and running, we should be okay. There are still plenty of people in the countries we recruit, as I mentioned, so over 145 countries.
Yeah.
There are plenty of people who want to work in our industry, want to work on ships, and just getting that pipeline going again, filling it with people who are trained and ready to be on the ships. And then the other barrier, of course, has been visas, because that whole visa, system shut down during the pandemic. And as governments are getting back up, there's a big backlog of applications for visas. And so just getting people the proper paperwork so they can work has been a challenge. And we're working through those dynamics as well. So those have been a couple of the things that have been challenging.
Yeah.
But because we were bringing the fleet back, not all at once, but ships at a time, we've been able to navigate through, have guest experience scores that are amongst the highest ever in the history of the business history of the industry. And so people are having a great time on board. They're getting great service. They're having great experiences. And we're going to continue to focus on that, while at the same time honoring that top priority of compliance, environmental protection, and health, safety, and well-being of everyone.
All right, so I just want to make sure you're right. You're getting all the employees you need, and it is costing you more, or no?
It's challenging. We are getting them. We have to be adaptable and flexible. Again, we go to over 700 ports around the world pre-COVID. We have 9 whirling cruise line brands in different countries. So we don't always perfectly have everything we want when we want it, but we're managing it. My people have been phenomenal in their level of dedication, commitment, and ingenuity in terms of making certain we are operating and executing at a high level despite all these challenges and barriers in an uncertain environment,
right,
where protocols are changing constantly. Can you get a vaccine? Where do you get a vaccine? Which vaccine should you get? Do you need a booster? Do you not need a booster? There's constantly changing dynamic, and they've done a tremendous job at execution. I couldn't be more proud of them. Overall, is it costing us more? I would say yes, on balance, it's costing us more. Is it costing us more to the point where is a huge increase in costs or something like that? So far, not that, as we said in the last business update, we didn't see ongoing costs that were going to be, dramatically higher. But we have to see, because again, this is real time. Things continue to evolve around the world, and we'll have to see where it goes.
So I want to get to timing of you moving to the vice chairman role. That happens August 1st. You talk about execution, and you had to execute a lot during your tenure as CEO of the company. And I knew you were familiar with it because you had been on the board, whether it comes to sustainability initiatives, but different crises that happened at the company. And I'm just curious, I wasn't surprised when the headline crossed, because you've been there for a while, but why now? Why was it now the right time to transition? And should we read this as an investment public that the worst is over for the pandemic? Or was this just personal?
Well, you should certainly read it as we have confidence. I have confidence. The board has confidence. And the management, the next generation that's coming in to run the company has confidence that we're pointing in the right direction, that we are on our way back, that we have a clear line of sight to how to accelerate repayment of debt through cash maximization in terms of cash generation and maximization. And so yes, not so much that it's all over, but that we are pointing in the right direction, and we see things look pretty bright ahead over time. Not that there won't be challenges, not that there may even be some hiccups or setbacks, because that's just the way the world is, but that overall we're well positioned. The other thing is just the timing is because it's time to get the next generation. I've been CEO for 9 years. When I first took the role, I talked about doing it for 3 to 5 years. So it's been quite a bit longer than that already.
Right.
But it's important now that we can see where we're headed, and we've got the right people. We've developed the people internally. Our people development processes have worked well. I'm very excited for Josh Weinstein, who's going to become CEO, president and CEO on August 1st. He has the right alignment of vision and values with where the company is headed. He has tremendous experience. He's been a key part of the getting through the pandemic and restarting the business. And he's led other parts of the business in the past, including when I moved them over to the UK to run our operations over there with our Cunard and P&O brands. And so a lot of experience. and the right time to get the next generation in. And Mickey Harrison, our chairman, is still around. I'll be vice chairman. I'll be around. We have, other members of the board.
How long will you be around? Are you going to stay for a while?
Yeah, absolutely. We'll see how long. I mean, I love it. Hardly anybody leaves this business. People love the cruise business. They hardly ever leave. And so I'm very much looking forward to, I have one primary responsibility, which is to help ensure that Josh is wildly successful. And that's along with the governance responsibilities I have, as a board member. But go ahead.
Arnold, you CEO for 9 years, on the board for much longer than that. What didn't you get to do that you wish you had?
That's a great question. There are always things that you wish you had a chance to do. One of the biggest things is that we are celebrating 50-year anniversary, 50-year birthday of our Carnival brand and our corporation. And the brand has done a very nice job of celebrating 50 years for the brand. But I really wanted to do kind of a blowout thank you celebration for 50 years for our corporation. And I didn't get to do that because it would have been inappropriate in the environment we were in with the pandemic, and also, given the fact that, we had paused for such a long time and weren't generating, positive earnings. And so, but I would have loved to have done a grand, celebration honoring the great legacy that Mickey Harrison family, all the people that have worked in this corporation, all of the partners who have supported it, the travel agent professionals, the ports, the destinations, the tour operators, all the people that depend on cruise for their livelihood, but have been, good partners for us. I would have loved to have done that. And unfortunately, we kind of had to take a quieter approach on that. So I have to leave it for Josh for the 75th celebration. Hopefully I'll still be around to participate.
So we've only got about a minute left here, and you said, you're going to be around for a while and make sure everything goes. And I know you wouldn't give me a time, but is there something after this? I mean, in terms of the corporate world or something, politics, anything?
Politics, I don't think so in politics, that's for sure. I have a number of partners that I've worked with in the past, private equity and others. And so I'll look at, as a sitting CEO, I can only be on one corporate board other than my own. Not as a sitting CEO, there may be some additional board opportunities. But I'm also going to, think about maybe becoming a news anchor. But now I'm kidding, guys.
I was like, wait. There's the red headline across the Bloomberg.
There are no openings here, okay? Arnold, no openings.
You can come. Sorry, Tim, but Arnold can come and co-anchor with me anytime.
All right, maybe just once.
We look forward to future conversations wherever you go. You've always been gracious with us and finding time for us. We wish you well, and I know we'll be talking again. Arnold, thank you so much. Be well.
Carol, thank you, Tim. You guys do a great job. Thank you very much.
You bet. Arnold Donald, of course, the CEO of Carnival Corporation. All right, right now we do want to get a check on world and national news. So much going on around the world. Over to Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. The second day of public testimony for the House committee investigating January 6th focused on former President Trump's election fraud claims. Committee Chair Benny Thompson questioned the head of digital politics at Fox News, Chris Stirewalt.
Mr. Stirewalt, after the votes were counted, who won the presidential election of 2020?
Joseph Robinette Biden Jr. of the great state of Delaware.
Thank you. That's the bottom line. We've had an election. Mr. Trump lost, but he refused to accept the results of the democratic process.
Stirewalt also explained the meaning of red mirage. That's the understanding that Trump would be ahead when the votes cast on Election Day were counted because Democrats were using mail-in ballots more than Republicans. Trump claimed victory on election night, even though ballots were still being counted. Now that a tentative deal has been reached on new gun safety measures, a bipartisan group is now trying to drum up support for the proposal. It does not go as far as the House plan, but Congressman Jim Clyburn, the House Majority Whip, tells Bloomberg he's happy something has been agreed to.
A half loaf is better than no loaf at all. I want the whole loaf. I will settle for the half loaf, and hopefully we'll come back later and get the rest of it. But that doesn't mean I'm going to be satisfied and rest on that. I'm going to still be working to try to do the whole thing.
Congressman Jim Clyburn, the Senate plans to call for enhanced background checks for people under 21 and increased mental health funding. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now back to you, Carol and Tim.
Thank you so much for that update, Nancy Lyons. Time to check in on the markets with Doug Krisner. Doug, we are still down over 20%, but off of session lows on the S&P.
You're absolutely right about that. The S&P had been down by as much as 3.9% earlier, Tim. Right now, the loss is just 3%. I say just because in relative terms, we are off the low, right? Dow Industrial Average off about 2.1%, and in the NASDAQ market, the composite index is down 3.8%. A lot of this heavy selling is tied to the bet that we're going to see a lot more aggression when it comes to Fed tightening. It's basically a continuation of the sell-off that we had in the U.S. on Friday, triggered, of course, by that hot reading on U.S. retail inflation. Now, the Fed has a meeting this week. We're expected to see a half-point rate hike. That's pretty much baked in at this point, although today some on the street are saying it could see a 75 basis point increase. I think the bigger question, though, is whether the Fed will show a commitment to fighting inflation by raising unemployment. Today, the CEO of Morgan Stanley, Jim Gorman, was saying he sees the risk of a U.S. recession right now at about 50%. We're having a move up in yields across the curve. A 10-year Treasury now at 3.35%, up by nearly 20 basis points. The 2-year is up 20 basis points now with a yield of 3.26%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Carol Master along with Tim Stanovic. I'm in our Interactive Broker studio. Tim is at his home in Brooklyn, and we do want to get to a story by our own Mike Regan, and it's really appropriate considering everything that's going on in our world as we keep an eye on continued selling in the stock market along with overall volatility. Tim, this is a story in the current issue of Bloomberg Business Week. It resonates about how the end of the stock market growth run makes everyone a bit of a bargain hunter.
The growth versus value debate, and so it continues. Mike Regan is senior editor at Bloomberg Markets. He joins us from the Bloomberg Interactive Brokers studio. So Mike, I mean, this story in the current issue of Bloomberg Business Week, so you wrote it, in all fairness, before today's route, but I think that today's route just brings it more into sharp relief. Explain why the growth versus value debate is taking on sort of a new type of debate in this bear market.
Oh, right, Tim. It's kind of a Pyrrhic victory, but value has finally started outperforming growth consistently since about November, which is when a lot of the growth indexes and as a result the NASDAQ indexes, peaked. The NASDAQ 100 and the S&P Pure Growth Index both peaked on November 19th. And the reason it's notable is because this notion of value investing almost seemed like it was done. It was left for dead because growth had outperformed for so long, for pretty much all of the previous decade plus. I looked at the pure growth versus pure value indexes, and it was something like 600 and some percent for growth and like 300 and some percent for value. So double the performance over about a 12-year period. And it really didn't sit well with a lot of investors because, if you think of sort of your textbook, how to invest Warren Buffett style, looking for value, low PEs, low price to book ratios, that whole notion just didn't work for years and years at a time. Instead, it was people buying into these, basically the very narrative-driven trade with growth, mostly tech-centric companies that had promised to disrupt the legacy companies in more or less every industry there is, right? And, investors just bought that story forever, and a lot of your traditional value investors just struggled for a decade. So, this story is kind of meant to mark that shift in momentum back to value and say, hey, wait a minute, value investing isn't quite dead just yet. And it sort of goes in to explain some of the reasons why value is finally seeing its day in the sun.
Okay, one more on growth, and then we'll talk more value. But you can't put all growth stocks in the same category here. And some analysts are essentially saying that, right? That just because we consider a stock a growth stock, a tech stock, doesn't necessarily mean it's like, the unprofitable, more, high-flying stocks that are down 70, 80, 90% from their highs.
Right. For a long time, synonymous with tech. And if not tech, by the letter of the law, you're very tech-heavy companies that might be technically classified something else, like Amazon's technically a retailer, Facebook, Google, they're technically communication stocks. But this notion of tech-centric companies being all that there was in growth.
And these are companies now that are making money.
Right. Absolutely making
That's
money
a big part
and
of
absolutely do have good growth outlooks. I mean, I think the epicenter of the underperformance and the drop in growth is not, these have become sort of your blue chip growth companies, whereas, the very speculative, expected to disrupt other companies further down the line with the long-term growth estimates that are, let's be honest, kind of penciled in, not really written in stone, led the way for a long time. Teslas and whatnot.
So does everybody believe this? Or, I mean, man, I'd really be wealthy if I,
yeah, right.
$1 for every time everybody's like, it's values time, it's values time.
Well, it's funny, if you look at sort of the mutual fund holdings, and we had a column today looking at insider buys, they're still, holding on to their growth stock holdings. So there is certainly, there's kind of some recency bias at play, perhaps. People did so well with these stocks for so many years that it's hard to just, erase everything you thought about them and go back to value. A lot of it really boils down to what everybody is fixated on, though, which is inflation and interest rates. I talked to Rob Arnott of Research Affiliates for the story, and he's, a classic proponent of value going back years and, forever, really, in his career. And he admitted, look, we looked pretty dumb for a decade here, so he's very humble about it. But to him, all his research indicates that in a very elevated inflation environment, that is when value performs well, because it's the stocks that have kind of been left behind but still have valid business models. They're just not really growing at eye-popping rates, but they have strong balance sheets. They pay strong dividends. They're buying back their shares.
Well, and it's like you see it in, like, I feel like some of the names. I was looking for gainers today, and it's like Smuckers and like just like these really. I mean,
you're lucky you
consumer
found
staples.
some gainers there.
Listen, it wasn't. It was really difficult. Although, if you go to the Russell, man, there's some really big movers. As right, Mike, there often is.
Right. Exactly. So, how long it lasts is anyone's guess, but Arnott makes a good case that, and I think a lot of people are coming to this realization right now, is that, first we had our fingers crossed that inflation was going to be transitory, as the Fed suggested. Then everyone sort of bought into the notion that inflation had peaked in the spring, and investors just keep getting proven wrong over and over again about how long this inflation is going to last. So should inflation remain to be hot, Arnott's argument is that value is going to continue to outperform for a few years now. Even if you just sort of revert back to the mean of how these stocks typically trade, growth is always more highly valued than value, but it was so much more highly valued that just from a reversion to the mean perspective, there's still a lot of outperformance left in value if it were to revert to the mean.
Hey, Mike, really quick comment in the 30 seconds that we have left. Back to definitions of growth versus value here, because we're starting to see the performance of energy companies perform in the sense that they're growth companies, and then you see company stock price like Meta Platforms, as you write about, the parent company of Facebook, slowing growth rate. That means it could be no longer a growth stock.
Yeah, right. There's been this absolute sort of changing of labels between many stocks. Energy for years was considered value because they were so lowly priced compared to their earnings and sales. But boy, this rally in oil has surprisingly, not surprisingly, but if you would have said this a few years ago, I think people would have been surprised that energy is now among some of the biggest weights in many growth indexes.
I kind of love how, like, all of a sudden, like, dividend reinvesting and like value, like, right?
Yeah,
like
back to the basics,
Very much.
You heard of this guy, Warren Buffett? You guys heard of this guy?
Heard of him.
Okay.
Man, he's got to be, you wonder if he's sitting at home and he's like rubbing his hands like, yeah, this is my world. Michael Regan, thank you so much. Mike is senior editor at Bloomberg Markets in our Interactive Brokers studio. Check it out, his story in the current issue of Bloomberg Businessweek magazine, available on newsstands, on the Bloomberg, and at Bloomberg.com/Businessweek. Carol Massar, Jim Stanovic. This is Bloomberg Businessweek on Bloomberg Radio.
close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We are just 60 minutes left from the trading session, and what a trading session. Caroline Hyde, Taylor Riggs, Gina Martin-Adams is in for our Romain Bostic, joined, well, not by our radio audience right now, but we continue to go cross-platform TV, radio, and YouTube. We welcome our audiences into what has been a decidedly turbulent day. We have, for once, Gina, volume spiking about 30% on the S&P 500, and indeed the stock, the overall valuations and the benchmark down more than 3.3% on the S&P, even more for the NASDAQ.
Yeah, and honestly, a lot of rotation inside the market. So as much as everything's down, there's been a lot of movement in the energy stocks today, which I find very intriguing because energy has been consistently the winner all year. Every stock in the energy sector up on the year. But today, when we started out the day, energy stocks were down more than 6.5%. They're now down about 4.25%. So we've seen a little bit of comeback in the energy space, but not enough to eliminate those losses, which is pretty meaningful in this current landscape.
Looking at those meaningful losses, NASDAQ off by more than 4%, 461 points to the downside. The Dow Jones Industrial Average off by 2.4%. So actually your outperformer of choice, but still down by 2.4%. We're at 30,636. The S&P languishing down 3.3%. That's 130 points off. And indeed, the Russell 2000, really the underperformer. The small caps, as we worry about recession risk, it's off by 4.3%.
Yeah, and at the sector level, really not much on the screen to get excited about. Tons of sector losses. We've seen energy stocks down, material stocks down, real estate stocks down. There is just not a lot to celebrate in the equity market. No green on the screen. I think there's one industry group that's up, and it's one stock in the construction and engineering space. So not a lot to celebrate today. Even those precious consumer staple stocks, Taylor, that we were talking about earlier, selling off on today's weakness.
Well, I love that. That's where I really want to go in some of my movers. I was taking a look at sort of where we were today with some of the worst performers and the best performers. And as you can see, even Coca-Cola down at the second to bottom line on your screen at one point was higher, but indeed, Caroline, that rolls over as well. To Gina's point, J.M. Smucker, when you think about maybe some of those traditional staple stocks, we're a little bit in the green. You're still up 3%, but I think what this highlights is the continued bifurcation in the market. The top there of the screen, the worst performers, it's sort of that classic reopening, maybe more of that risk on trade when you think about Penn National Gaming, MGM Resorts. We've talked a lot about the cruise lines and the airlines today also getting hit a little bit harder. So that sort of shows maybe that rotation within the market that Gina's been talking about.
Yeah, and is that because we've still got such an ugly inflation print, but also such an ugly consumer sentiment print? What does that mean in terms of the consumer wanting to go out and spend? And what about the poor retail investor right now who's just looking at their portfolio and thinking, there has been no place to hide? I show you that the traditional safety play, which was 60 equities, 40 bonds, has not worked. You're set for the worst quarter on your 60-40 portfolio since 2008. So really painful overall. I'm pleased to say that, well, I think we've got Carol managing to alleviate some of our overall technical issues, and we welcome you to the party. What a downbeat party it is today, Carol.
Yeah, listen, there's gremlins, it feels like, in the market. It is so downbeat, right? There's no place to hide. And what's interesting is, you know, our team, Radio TV, have been talking to some great voices over at Evercore, Morgan Stanley, also at Invesco. And here's what they had to say when it comes to markets, the Fed. Just check it out. The tone, though, is so downbeat.
This week is fraught with peril. Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
You know, we wonder if there's full market capitulation. It certainly feels like in the conversation, but that was Julian Emanuel over at Evercore ISI, Matthew Hornback over at Morgan Stanley, Christina Hooper at Invesco. And what's interesting is you guys were detailing how rough it is in the markets today. Take a look, though. Little context, 52-week lows. There's a great chart. I was working with our Abigail Doolittle, bringing it up. We've got about 152 names in the S&P 500 taking out new lows. For our radio audience, there is a chart that our TV team can see, and there's a real big dip back in March of 2020. That's when we saw so many stocks increasingly or overwhelmingly hitting 52-week lows. We're well off of that, but again, you can see more recently, we have more stocks hitting 52-week lows versus highs at this point. And, Gene, I think about what you always say, like, it's not in an earnings recession, right? Like, but we have to keep an eye on what we're seeing in terms of earnings growth margins, because whether or not names kind of grow into those 52-week lows.
Yeah, and it is very much a technical phenomenon. Bottoms are always made on technicals and sentiment. So as much as we want to look at earnings, we want to look at valuations, there's few magic indicators in that space, which is why you hear so many people talking about when are those big capitulation moments going to emerge, because we know that's what typically creates a bottom, or at least keys off a bottoming process. I'd say today, the one silver lining I keep pointing out today is that at least there are some early signs of capitulation starting to emerge, both in sentiment and the language. Look at all those videos that we showed prior to our conversation, everyone getting a little bit more bearish, and in the pure technicals with 5% of names on the index now trading above their 50-day moving average. That's the lowest we've seen since 2020's lows.
Caroline, I'm really honing in on some of the sentiment levels. I know for our TV audience, we've been talking a little bit about this. Some of the notes I was reading, BlackRock, Standard Chartered, TIAA, and Piper Sandler, that, you know, sort of all of the economists and the strategists. And I think in the past, a lot of the narrative we'd heard is things are bad, but the consumer, still so good. And finally today, I was like, oh, there isn't a lot of but and the positives, and a lot of that's being left out. A lot of this is like the Fed is behind, the Fed needs to move, hard to get a soft landing. Is sort of the more bearishness when we think about some of the sentiment and not really highlighting a lot of those positives that are left.
And just think about where we came into this. I mean, you could have tapped the mood music late last night, 10 p.m., when you really looked at the crypto markets, absolutely having a torrid time of it.
Caroline was up all night figuring out the crypto market at 3 a.m.
I wish I was merrily asleep, unlike others in my family. But there was definitely a deterioration there, and whether there is that correlation effect, whether there was that spillover effect of this is ugly there, and then what does that mean for tech stocks? What does that mean for broader market sentiment overall?
Yeah, and you just wonder how much of this continues right through the midweek Fed meeting, right? Everyone's sort of keyed up now for what's the Fed going to say on Wednesday. Will we get 75 basis points and then a follow of more 75 basis points to come? Or are we stuck at 50? What's the language going to be in the presser? I think there's just so much uncertainty with respect to Wednesday coming that we might be in for a lot of this in the near term. But until we could get through that meeting at the very least.
Right, like how much is priced in, or how much what can the Fed say at this point to surprise certainly when investors and maybe take markets down another leg? So we shall certainly see. All right, guys, that's going to do it for this moment. We're going to be back in less than an hour's time on radio, TV, and YouTube. We're going to be back for Beyond the Bell, our cross-platform coverage. Our simulcast will count you down to the close on this Monday.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
You know, Tim, Carol Massar, Tim Stenovic here on Bloomberg Business Week on Bloomberg Radio. It does feel like everybody is increasingly throwing in the towel. But I think it's also, you know, an acknowledgement that inflation's going to probably stick around. We're going to talk about the oil markets with Javier Blas a little bit later on. It's just a recognition of where we are, and it's nothing that's going to change overnight. And if the Fed is going to have to be a lot more aggressive, that's going to be problematic for the economy and likely to take us down to a recession.
Yeah, and we're going to talk about that with Rich Miller in just a minute, economics reporter for Bloomberg News. He's got a great piece out about how we're facing the choice between elevated U.S. inflation and recession. I want to go back to the interview that we had with Arnold Donald a few minutes ago, because despite what we're seeing in the macroeconomic environment, and correct me if I'm wrong, he seemed really optimistic about his industry. And yes, he didn't say it was recession-proof. He said it was recession-resistant because people, if they're working, they do want to take vacations, and he sees value when it comes to cruises. But for all the talk of we haven't seen this in 40 years, he says we do have periods like this when we have inflationary periods. We have high gas prices. He's not seeing it the same way that some other CEOs are.
No, and this is why I love to have conversations with people who've seen a lot of different market cycles, right? And this one there are some unique aspects to it, no doubt about it. I mean, coming out of a pandemic, we don't know exactly how this plays out, right? And when you have such extreme swings so quickly, right? They're not spread out over 3 years or 10 years, right? That they happen so quickly, and we understand why they did. You know, you don't know exactly what the impact is longer term and how everything works its way out. But I agree with you, you know, especially for the U.S. market, you know, people coming back, there's pent-up demand. People want to travel, Tim, and they've saved money, and maybe they're not going to go out and buy clothes or some other stuff, or, you know, but they're going to go travel.
Okay, neighbors, weekend trip to Wisconsin to visit family, several $1,000s for tickets for 4.
That's a lot of money. Yeah. But they're doing it.
They did it. Their flight was canceled on the way home.
Oh, I'm sorry.
Brutal.
Oh, my God. Enough. All right, let's get to world and national news. Back over to Nancy Lyons. She's in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. The House Committee on the January 6th insurrection today aired President Trump's claims of extensive voter fraud and said Trump persisted in airing the claims even after he was informed they were untrue. Bloomberg's Irv Chapman has details from Washington.
Republican member of the Philadelphia City Commission, Al Schmidt, looked into the allegation that 8,000 dead people had voted absentee.
Not only was there not evidence of 8,000 dead voters, there wasn't evidence of 8.
As U.S. Attorney in Georgia, B.J. Pak was asked to check the claims of fraudulent vote counting in Atlanta.
Nothing irregular happened in the counting. The allegations were false.
Acting Deputy Attorney General Richard Donahue added,
I told the president myself these allegations was not true.
The committee said Trump has used the debunked claims to continue political fundraising, raking in more than $250 million. In Washington, Irv Chapman, Bloomberg Radio.
31 members of the white nationalist group Patriot Front are expected in court today to face charges of plotting to violently disrupt a weekend pride event in Coeur d'Alene, Idaho. Police Chief Lee White credits a local resident for tipping off authorities.
This one concerned citizen, rather than pulling out their phone and videotaping this for their 15 minutes on YouTube or Snapchatting it or something like that, took the time to call 911 and report some suspicious activity. And as a result, we likely stopped a riot from happening downtown.
White says the caller saw the men loading into a U-Haul truck, all dressed alike, wearing masks and carrying shields. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master along with Tim Stanovic. I'm in our Interactive Broker studio. Tim is working from home today. Elon Musk, did you see what he had to say?
Yeah, well, I don't work at Tesla, so I don't get this memo, but fortunately Ed Ludlow is around and he can report on it. Musk encouraging Tesla staff while warning of a, quote, tough quarter. Tesla has had a, quote, very rough quarter as it struggles with supply chain snags. This according to CEO Elon Musk. He warned in an internal memo imploring workers to help get the electric vehicle maker back on track.
So we need to rally hard to recover, right? This is what he said. I mean, we've been watching what's been going on in China for Tesla specifically. The Shanghai plant, which had slowed production in recent weeks because of those severe COVID-19 restrictions, is returning to full strength, and its Austin, Texas facility is ramping up production as well. This is what Elon Musk said, but last week he noted Tesla's Berlin factory built almost 1,000 cars, while its Fremont, California plant notched a record day of production. So he's seeing a lot of production, but man, I don't know. How do you take it when he says it's good?
Well, yeah. I think we have to look at it in the context of the way that Musk communicates normally internally. So as Ed reminds us, he often does send these company-wide emails near the end of a quarter to push staff to the finish line, to help them sprint to the finish. Tesla is known to deliver many units in the final week, so sort of cramming like, some people would do back in college before a big exam, I guess you could say. In a subsequent memo, he did tell workers to be proud of the, quote, great real products that they make.
And I guess this is in contrast to what we saw, right, earlier this month, where he warned of layoffs among salaried employees and his, quote, super bad feeling, unquote, about the economy.
Yeah, in the first 3 months of the year, the EV maker delivering more than 310,000 cars, a quarterly record. It came in above analyst estimates. This, though, as supply chain challenges were offset by accelerating EV adoption. Analysts are forecasting Tesla will deliver about 296,000 units this quarter. That's according to data compiled by Bloomberg.
Shares of Tesla. Now, mind you, the market's overall down, but this one's down a bit more than the broader market. It's down about 7.2% in today's session. Yeah, after losing about 3% last Friday. All right, folks, we're going to talk more broadly about the economy and the Fed. That's coming up next. This is Bloomberg Radio.